to the Build Passive Income and Create Financial Security webinar hosted by Own Real Estate. My name is Wilson, and we started the team about 5 years ago, been in business for over 10 years. I have an amazing supporting cast here. Ashley and Panise are going to be speaking, and also Annie's manning the slides. Sherm's going to be fielding the questions. Just really appreciate everyone being here. Just a little bit background about who I am, and then I'll let some of our team members speak as well. I started in real estate 10 years ago and have just stuck to it. And just, like I said, really lucky to be in business with some amazing people. What about you, Ash?
Hello, everyone. I'm Ashley. I'm on Wilson's team here. Excited to share some stories with you all today. I started investing in real estate back in 2015, and I'm excited to share some of those experiences with you and some of the lessons I've learned along the way. And in the Bay Area, I got my license back in 2018 and have been helping families here in the Bay Area, as well as referring some investors out of state. So we're here to help and answer any of your questions, and then I'll let Panise share a little bit too.
Thank you, Ashley. Hi, everyone. I'm Panise. I'm also on Wilson's team. So excited to be here with all of you today, and thank you so much for joining. I started real estate investing back in 2010, actually with my father. My family is an immigrant, and the only source of income that he was able to build here in the US was through investing in real estate. So I was very lucky to learn from him and side by side help him grow his little investment into something bigger. And today I'm a proud investor here in the Bay Area and Austin, Texas, out of state. So really excited to be sharing some of the things that I've learned over the past 10 years and shared with you guys. So hopefully you can replicate some of the success and minimize the failures that we had over the years.
Thank you, Ash and Panise. Annie, Sherm, you guys wanted to make a quick intro as well?
Sure, I'm on the marketing team and I'm new to real estate as well. So I'm learning alongside you, and I'm learning from all of these experienced compared to me individuals and real estate agents. So I'm excited to learn and listen in.
Yeah, my name is Hassam. For those that I'm a little more closer with, everyone calls me Sherm. I started investing, I had my first investment property back in 2015 that I flipped after a year. And that kind of snowballed into me actually wanting to do the selling side of it. And that's when I transitioned to full-time real estate, coming up here and working with Wilson and the team in 2018. So I've been on Wilson's team for almost 3 years now. Very proud and grateful for that. And I don't even have the close of credentials that Panise and Ashley do in investing, but I'm also here to learn and help however I can. So any questions, let me know.
Appreciate the intros. And for those that didn't hear, if you have any questions, I've made everyone have the ability to unmute. So it might be also easier that we save most questions to the end. We're likely going to have a Q&A, and you can type in your questions in the chat as well. So let's get started. So, we have varying experiences between Ashley, Panise, and myself. And also, of course, we are in a network of various investors and business owners as well. So a lot of what we're going to share is going to be firsthand ourselves and our experience, but also it's going to be what we know of other people and what they've executed on. So, one of the key questions that we have is, what are your investment goals? Are you a savvy investor, a veteran that you've invested in various different types of real estate, syndications, commercial, residential, apartments? We would like to know. So feel free to type in the chat. Even if you're looking for your first investment as well, a lot of us, actually myself, would consider a potential first investment as your primary residence, because we're going to talk about, how, all of that is going to affect your long-term future and the benefit of being able to just save and have an appreciating asset that's going to hedge against inflation. And really, there's a huge, vast difference between the net worth of a renter versus a homeowner, even if it's just having the primary residence. So we'll go to the next slide. So here's what we're going to be discussing today. We're going to be talking about real estate in general as a vehicle for financial freedom. We're going to talk about house hacking, touch upon AirBNB, investing in real estate. We're going to talk about out-of-state investing as well. We're going to do some analysis on some of our own investments and look at the numbers. And also, if you guys do have any specific questions, obviously we can talk about deals as well. So also, just at the bottom, you'll see that there's a little disclaimer. We can't provide tax or legal advice or accounting advice. So this is for informational purposes. Just wanted to put that out there. If you do have more specific questions, feel free to reach out to us. And also, if you're looking for a vendor/professional on the tax or legal side, we can make an introduction too. If you have a really good person, we'd love an intro to that person as well. So we'll go on to the next slide. So let's talk about big why real quick. You know, on our team, we have a vision, and the vision is for internal facing for our team, but also it is for us to be able to position our clients and our friends and people that we really care about in a good place. So we define it as doing what you want, when you want to, where you want to, with who you want, as much as you want. And it should be a decision. Yet, I do believe that some of our educational system, as great as it is, does have some flaws. And also, sometimes the information that we are looking for in terms of wealth building isn't readily available, and we do have to search. So the purpose of today's webinar is to really talk as much as we can about our experiences so you can shortcut the learning process. So, and those are some pictures of Ashley and Panise and myself and some of our team members and some of our clients that we've helped along the way. So we'll go on to the next slide. Part of knowing the big why too, you see a video playing. This is actually the house that my father grew up in China, rural Toisan. And there was no plumbing, no electricity, no mattress, literally brick and wood. He slept on that plank wood on top. In China, it gets really hot and humid, yet that was the normal way of life. So what we realize is real estate, especially on the residential side, everyone needs a place to live. So that's why even during the pandemic, you see real estate prices going up. Interest rates are, whether we consider it artificially kept lower or if it's obviously purposefully kept low to make it affordable for us to be able to purchase, let's say, a home and also other real estate investments. That's the opportunity that we see because obviously people need a place to live. Even if they can't afford a place to buy themselves, they're going to obviously rent somewhere in the United States. So part of it too is really understanding where your expenses lie. And actually, we will be providing a takeaway at the end of the webinar. It's going to be a Google Sheet that you'll be able to make a copy with a bunch of resources, from links to different websites where you can do research on different areas or how to calculate different returns on your investment. Also, it's going to be calculations on the relationship between different things such as interest and also appreciation. And this specific one, there's a calculator that we're providing that's about your personal expenses, what you need minimal to live on. And I'm a part of a coaching group with Terriel. Thank you, Terriel, for being here. We always talk about horizontal income versus vertical income. And if you don't know the difference and it's your first time hearing those two terms, I'll explain what they are. Horizontal income is what income comes in on a yearly, monthly, however frequency basis without needing your time commitment to earn it, which means it is passive. Vertical income is what we do with our time, which typically is our job. So we have been conditioned in society to work really hard to increase our income, yet typically our ordinary income is taxed at the highest brackets. So another benefit of obviously building a passive portfolio is how can I closely track my expenses relative to increasing my horizontal passive income to the point where maybe one day I could make that decision that I don't have to work a 9 to 5 anymore. And if you do, it's by choice because you're possibly in your passion zone for whatever you're doing. So that's something that I wanted to keep in mind. You'll get that sheet, you'll calculate your personal expenses, and you'll know exactly where to start. Whether you have an investment property or passive income assets, such as a business as well, or you're starting from scratch, at least you know exactly where you need to be on a monthly basis. And let's move forward. Just quickly, building wealth in real estate. Where in this chart, you're seeing the difference between real estate stocks, bonds, and holding on to cash, where there's going to be some benefits to some assets and some are missing, obviously, all 5 of these that you see on this chart. High cash yield, equity buildup because it's forced savings, right, in your house or in your investment property. You have a leverage, right? Banks will obviously vet the property and vet your background, your financials, but they're willing to give you a loan to value depending on the size of the deal. It's a hard asset. As we know, a lot of people need to live somewhere if it's residential, and people need to work in places if it's commercial. And then, of course, there's tax advantages. If it's an investment property, you can 1099 it. Any gain or what we call boot could be tax deferred into a bigger property and so forth. Also, there's other things that we'll be talking about in terms of tax advantages too. And just a reminder, we're not tax professionals, but at least from our experience, we're sharing some numbers with you. Okay, we added this chart in here just because we realized some of our guests might also still be renting or know of friends or relatives that are still renting. And this chart just shows you the power of visualizing and seeing how much rent actually is over different periods of years that we've rented. So it's just a painful thing. That's a reminder that when you rent a place, there are no long-term compounding benefits other than having a roof over your head and maybe an annual signing of a lease, and that's the security you have. So we highly encourage, if you're staying in the area or you're going to live somewhere and it takes a little bit to save on down payment, you eventually become a homeowner because there's going to be definitely some things that you'll benefit from besides just looking at the numbers of how much am I paying in rent and how much am I paying in mortgage. Okay, different strategies. There's going to be house hacking and being an Airbnb host. And we also are going to share a little bit on the numbers of investing out of state and different size apartments. We're also going to talk about commercial investing and how to use a cost segregation study so you can have a massive loss on your taxes against your taxes if you can claim yourself as a real estate professional. And also we're going to talk about purely passive investments, investing money into a syndication, and what that would look like. Okay, so this is a chart that has been relatively compelling, and I wanted to share this. It's something that you want to screenshot so you can always have awareness in terms of where you're spending your time or where you're investing. So I'm actually going to start on the right side, which is cash influx. When you're flipping, you're working on foreclosures, you're rehabbing a home, and you're wholesaling a property to someone else to rehab, honestly, that's a job. It requires your time. What else would be considered a job? Our W-2 job, right? Anything we do with our time to earn a wage or to earn a bonus. Commission dollars as real estate agents is considered a job. So not passive at all. However, most people have to start working hard and saving in this job category to fund appreciation and cash flow deals. Most people are going to put assets, let's say in real estate locally, on the left-hand column, which is we can get rich from it, but we aren't going to get income from it, right? We can't live off a property that's break even. Nothing's coming from there to help us with our personal expenses. But there are benefits to it, obviously. Forced appreciation, you can time the market, whether it's a normal market or, over a long period of time. If you look at appreciation throughout, you're always going to see year over year positive appreciation. Single family residences in an appreciating market, that's another place that you can invest in. But typically, the cap rate is not that positive that you can really just depend on one or several of these to live off of. And then, of course, there's going to be situations where you're going to invest in a property and have negative cash flow, but have an anticipation that it's going to appreciate at a more rapid pace. Of course, you're going to want to have a mix of, in the middle column, cash flow positive properties. That's how you can get wealthy. That's how you can build passive income. And that's income producing properties. And that's also businesses. So here's just some tools that we use online. There's a lot more, but here's some of the logos and the places that we look for data. We're a sheet that's going to have all the websites, and you can browse through at a later time. So we'll skip this one. So first is defining a criteria in what you're looking for. Are you looking purely for cash on cash return? Are you looking at the internal rate of return on an annual basis? Is the cap rate the most important thing for you that you're looking at? What's your purchase range? What do you qualify for? Is lending on the residential side different from the commercial side? And it is to a certain extent. Are you looking for something that's a single unit, a single family home? Or are you looking for something with multiple doors? In different marketplaces, for example, if it costs $1 million for a single family home here, what marketplaces can you buy multiple doors, apartments for that same $1 million? Down payment requirements, interest rates are going to be a little different. Of course, the vendors that you're going to need are going to be a little different too. You can't manage something if it's out of area. So we're also going to talk about building the right team. Are you looking for something that's more turnkey, that you don't have to worry about any BRRRR method or rehab strategy? And purely passive might look like something like a syndication. Do you want to park your money if it's, let's say, $50,000 in a syndication and get a return on a monthly basis, and also get a multiple of that money when they sell that asset because they're actually using the BRRRR method? And the most important thing is being specific in what you want. Just like searching for a primary residence, we all start in maybe a more generic manner because we're not sure exactly what we want. And as we start to research, as we start to set foot in the door of different neighborhoods, of different homes, we're going to have eventually a better idea of what we really want. So we'll move on. So let's talk about this first method of, of investment, and it's called house hacking. I'm using the picture in this property as an example. It's something that we had sold and represented. In May 2020, someone bought this for $1.294, $400,000 down payment. The interest rate was 3.125. And then just putting some numbers together, PITI, which is mortgage, principal, interest, taxes, and insurance, added up to be about $5,480. Now, the only thing missing in this calculation is the utilities, which could be pushed onto tenants. So if we were to independently rent out the rooms and still occupy one for the homeowner, and each room rented out for $1,200, that means you're getting a monthly cash of about $4,800, which means for the individual that purchased this home and qualified, their personal monthly investment is $680. And we're going to do some math for you because I think this is one benefit. You're living in the Bay Area for a couple $100. You owned a house, but what else is the benefit? If you look on the right, I punched in some numbers. The property value, it's 12 payments a year because it's obviously one payment per month. 30 years is the product. It's a jumbo loan. Interest is 3.125 up to 3.13. And assuming that appreciation, which I took the 6% from all of California over the last couple of years, including the last downturn. If you go to the next chart, here's the insane thing. Let's compare the cumulative interest that you will pay during the life of the loan versus the appreciation gain that's compounded based on the purchase price that you've made. If you look where it says leverage under appreciation, there's a plus L. That means from year number one, you are making a positive investment as you obviously are owning the property. You're going to be making $25,000 in interest payments. However, the property value at 6% gain annually, the property has gained $77,000 in value. So if you look at the bottom, over the period of 30 years, if you isolate that number of cumulative interest paid, it's a scary number. You're going to pay to the bank $481,000. When you go sign loan docs, closing as a buyer, for those that recently went through that or recall that at the title company or with the traveling notary, you remember seeing over the life of the loan, how much out of pocket it's going to cost you. And it's a scary number. But the thing that's missing from that is in this equation on the right. Because the appreciation is based on 6% of not the loan amount, it's of the purchase price. Over the period of the ownership in 30 years, you're going to gain $6,138,000 in appreciation. That's eventually helping you hedge against inflation, and wages aren't growing as fast as home values. But this is a powerful tool that we're going to give you so you can punch your own numbers for your own primary residence, for your own investments, so you can see the power of investing in real estate. Fine. Let's assume appreciation is less than 6%. Punch the number in as 3% appreciation per year, 4%. What you'll find is that's still going to be positive leverage from year one all the way to year 30 after you pay off your loan. This also does not include the tax benefits of paying interest. It does not include the principal pay down of the mortgage. This is just property value increasing. So that's the amazing thing. There's so many benefits to this. This also doesn't include the depreciation you can take against the property itself. Let's move to the next one. This is the chart with the numbers that we just reviewed. In blue is a property value over 30 years, the gain, and in red is the interest you pay off over to 30 years. Because as you know, if you're getting a 30-year fixed rate mortgage, majority of the first initial years are primarily heavy on interest and then less and less and less as the loan matures. So let's move on. And that's the power of leverage. We're also going to talk a little bit more about how buying cash might have its benefits, but also leveraging a loan sometimes is more advantageous. Ashley?
I was just going to step in. I figured you might need a break from chatting, drink some water. I'll talk a little bit about the power of leverage. So the first example that I'm going to dive to in just a little bit, we use conventional financing. So this right here is essentially giving you an idea of how much you can afford and how you can leverage that potentially on this first investment property that you're looking into. So to easily calculate, you could go to Zillow Mortgage and check your house affordability. But for roughly purposes, if you take your yearly income and multiply it by 5, you can get a pretty good idea on how much you can afford, plus the cash down payment that you might have liquid. And then what the lenders are going to look into is your max debt to income, how much you have in debt. And you're going to need to fall between 45 to 50% for that, as well as having a pretty solid credit score of 680 plus. And if you are going to have mortgages, you can only have up to 10 underneath your name. So some different strategies my significant other and I have done is each time we purchase a property, it's either in one of his names or my name. so that we can have up to 20. So just different ways that you can leverage that. The next slide we're going to dive into is how to analyze rental real estate and what you should be looking for when you are deciding where you want to invest in. That is going to be everyone's biggest struggle, is figuring out where. So it's just get started, pick a location. Roofstock is one of the websites that we had mentioned on that previous slide. That's one that I typically recommend to investors to help them get started on where they should invest. Roofstock is a program where you can essentially, for first-time investors, it can be a way for you to maybe just get your feet wet. But if you want to try it on your own, look at where they're investing and then build your core 4 team. Reach out to us as real estate agents. We have a large network throughout the United States and internationally, to be honest. But create that core 4. So finding a real estate agent local in that market is also what's going to help you find contractors, property managers, and then also lenders in the area. So if you can find a real estate agent that's open to working with investors, that's the key thing there. They will send you properties and you can find some great assets, because sometimes they will have properties before they even hit the market and that are great for investors that might already have tenants in place. I've purchased properties that way. So it's great if you can find a real estate agent that's willing to bring you those properties. So that's part of your core 4 team, people on the ground. And then something to also look into that can be a little bit easier as you're just guiding yourself through before punching all the numbers in and calculating cap rates. And that kind of makes it a little more complicated, is what we call the 1% rule. If you're purchasing a property for $150,000, your monthly rent, if you can get $1,500 in that market, is going to be a good return on just calculating that investment. Whether or not it's a good idea is what we've used as a marking point. And then other things to look out for that are more common here in the Bay Area, but may not be common in other areas, is if they provide inspection reports, that's wonderful. In areas that it may not be as common, you're going to want to make sure that you're adding those contingencies, that you're inspecting the property. Some of the bigger items, the HVAC, the roof, foundation, and electrical. Those are things that you're going to want to take into consideration when purchasing a property. Outside of the Bay Area, you can sometimes negotiate those things. In the Bay Area, it's a little more difficult, since it can be a little more competitive here. Also, just looking out for what listings are active, are homes selling nearby, what are they selling for, comparables. Also, as well as growth, education, and then looking at the different types of neighborhood classes. There's ratings for neighborhoods. You can use websites such as Trulia or that Roofstock to see what the neighborhood's like if you're not familiar with it. And then some other things that I look into is if there's universities, if there's airports. Those can be 2 factors when looking in whether or not it's a good rental market. If there's a lot of housing and that type of thing for students, it can be a great long-term rentability. Maybe now during COVID, it could be a little bit different, but I'm still 100% for universities. I think we'll be coming back and really strong soon. And if there's like big trees and boarded up houses, these can sometimes be questionable areas, but just seeing what things are selling for in that area can really give you a good idea on what to look for. So hop on Google Maps, type in the address, take a little tour around the neighborhood. You don't have to physically be there to see if it's the right fit for you. And I think next slide, we're going to dive into some examples. I think. Yes. So this was the first property I purchased. I invest currently solely in Indianapolis. I'm originally from Indiana, go Hoosiers. And so this was the first property I purchased back in 2015. We did conventional financing. We put the traditional 25% down for an investment property. And this is one of those kind of cookie cutter neighborhoods where there is a little bit of an HOA because there's a community pool and park and those types of things. So we did take that into consideration, that long term we knew that the community was going to be a great development, and there's great schools in the area. And as you can see, one of the neighbors actually just sold for close to 290 and similar homes. So the current value is 266, which is feeling really good right now. And we didn't know about the 1% rule when we first purchased. And so learning lessons along the way, but we're currently getting 1,400, which still feels really great. And biggest lesson here was I thought I could do it all on my own from California because I had a real estate background. Not the case. Still hire property managers. They can find you good tenants that can qualify and do all the background checks. And so that was one of the biggest lessons I've learned. So finding someone that can be reliable. If you're planning on focusing in on an area such as myself in Indianapolis, you can sometimes find property managers that the more properties you bring, the bigger discount you get. And so that's just my first example there. The next one is a fun one. It's one of my favorites. It is one that we use as an example of the BRRRR method: buy, rehab, refinance, and repeat. So we actually purchased this single family 3-bedroom, 2-bath home for $45,000. It was brought to us from a real estate agent in the area that knew that we were interested in investing. We bought that. The seller was an investor who was offloading a lot of properties. So we actually had a potential to purchase more if we wanted to, but we focused in on this one. The other thing that we did with this one was we used a private money lender. So we brought some of the skin to the game, but the private money lender was bringing in a good portion of it as well. And so for 1 full year, they were on title with us. And then at the end, we paid them a lump sum of interest of 6%. So it was much higher than you're going to get from leaving your money in a bank account. So he was able to make some money, and then he made his money back. And then he was like, hey, are you guys buying more? So it was a quick, easy return for him. And then we actually purchased it with tenants in place. Once they moved out, we did a little bit of fixing it up. We also used someone else's money for that $22,000. So we didn't even use our own. And we paid back, that's when we paid back the private money lender, as well as the lender, or the private money lender that let us use the $22,000. And we had the property appraised, and it came back at $130,000. So we were able to pay back the investor, pay back the lender, as well as have a mortgage on it now, which is very low. It's barely nothing. And then we bought the next property. So currently this home is it's in the Fountain Square neighborhood. If you watch any of the HD TV shows, Good Bones is actually based in this neighborhood. So they're really helping with our home values, because that's where they're flipping all the properties. They actually live in the neighborhood, which is great. And so it's currently up to close to 200,000. And we purchased this just a few years ago. So feeling good about that. We get 1,100 in rent. And this one, we just learned to leverage other people's money. We didn't really have to come in with much, and we were able to finance that to purchase the next one. Next example is the townhome on Lupine. We purchased in 2018 for $50,000, 3 bedrooms, 2.5 baths. Currently valued at $70,000 and renting about $1,000. It is in the Speedway neighborhood, area where the Indianapolis 500 takes place. So when we purchased this, we actually purchased it from another investor, and we let him continue to AirBNB it. So it was actually an Airbnb until COVID hit. And then he asked if he could get out of the lease, and we have new tenants in there now because it was a little difficult for him. There was no Indianapolis 500, which is where he was making a lot of his money. So we built a great relationship with him through the investor network that we're a part of. And so it was a great way to leverage Airbnb, because he was able to make that income and have a little on the side. And we had rent coming in. So it was that consistent rent that we knew he would be paying as the quote unquote tenant. And so that's another way is we've thought about keeping it as an Airbnb ourselves, because a lot of areas now actually have Airbnb local host that will manage the properties for you and just take a little bit off the top, and then you get all the income from it. So that's another way to leverage Airbnb with these investments. And so we were able to purchase this one with the liquidity from the last one. And then the last example I'll share, and then I'll pass it off to Panise, is the most recent one we purchased in 2020 during COVID. We had a family friend who had been following me on Instagram and was like, hey, are you still buying properties? We don't want to be landlords anymore. We want to sell this and purchase a single family home. And so they had tenants in place already. And so part of the negotiation that we did with this one was we asked that the tenants sign another year lease because they were already paying $1,200. So we were like, yes, let's keep them in. We don't know what's going to happen with COVID. So that was part of the agreement of our purchase. And already less than a year, we've almost appreciated $45,000. So definitely happy with this purchase. And this was something that I learned along the way was every time I'd go to Indiana, I'd post us. We went and done tax lien sales. That would probably be another conversation. It's something now that has become more of people are actually taking it on as a career, going and buying tax lien sales. We purchased two. The homeowners ended up paying the taxes, so we made the interest back, which was a nice little side deal. But they really, to really be big in the tax lien industry, I think you have to have a little more focus than we had. But anytime I go to Indianapolis, I tell the stories, and that's how I ended up getting this investment property. So just different avenues of finding investments along the way. So hopefully that was helpful.
Thank you, Ashley. That was so, I mean, it was helpful for me to see what's happening in Indiana, because that's a market that did not cross my mind when I was looking and searching for areas to invest in. So a little bit about this particular Bridlington Court property that we purchased in January 2021. When my husband and I were discussing where we were going to invest, we definitely knew that California was not going to be it with the amount that we had reserved for investment. So we started looking out of state. A couple of states came up for us. Florida was one and Texas was another. And we did a lot of research, about 6 months of research to pick one city, which we ended with Austin. And I'll tell you a little bit more about how we ended up with Austin. But really, as Ashley was talking about, making sure that you know the reasoning behind, and also picking your for team and making sure that you have those folks on the ground. This same thing is for us that we went to Austin, because when we ended up looking at the market conditions and the job market and the economic growth of the city of Austin, it was kind of for us like a replication of the Bay Area. And being so familiar with the tech industry and the tech boom here in the Bay Area, we kind of wanted to be in that era of Austin going through the same transition. So we were pretty sold on the city of Austin. And the search started with obviously looking for the best and top agents in Austin that could help us and put us in touch with all the right people. So when we found this opportunity, this actually was an over listed property on the market. And in a very hot market right now in Austin, which homes are not really going to stay on the market for longer than 7 to 10 days. This particular property was on the market for 14 days when we approached it. And we kind of knew that the listing agent, unfortunately, didn't really know that it was listed as too high. She was not super experienced, which is why it's really important that you work with people that are experienced, whether it's in the neighborhood or in the area, to know exactly how to strategize and price your property or your listing well, because investors or property people that are looking for properties can actually tell that it is over listed and use that as a negotiation tactic. So that was our approach with Bridlington Court. It was listed at $540, but of course we were not going to pay that back in January. We ended up paying $485 with a down payment of $241 and interest rate of 2.9. It's a 4-bedroom, 2-bath. Our monthly payment right now is $1,400, and the estimated current value of this house in the past 2-3 months has been appreciated over $35,000. It's right now at 510 according to Zillow's estimate. So and what's being sold in the neighborhood right now. The current rate on rent on it is $2,800. And the biggest lesson we learned is you got to act fast. When you are going into an appreciating market such as Austin and majority of the markets, metro markets in the US right now, with inventories being so low, if you see that the property hits a lot of your your criteria, it's hitting a lot of those points, it's important to act fast. And part of acting fast is having your finances done and making sure that you do feel very prepared to put an offer out. So recommendation for me and all of us agents to buyers is that regardless of whether it's your primary residence or if you're looking to purchase your first investment property, make sure that you speak to a lender and make sure that you understand your purchase power, because that's going to enable you to be able to act fast and capture an awesome opportunity like this one. Next one is a very similar replication. So this property, it's in the same zip code. We just saw what was happening in the zip code. It's actually very close to Elon Musk's newest project with Tesla in southern parts of Austin. So as soon as we started looking into that zip code, I told my realtor that this is where I want to do my next project and stay in this neighborhood. And of course, when you have those relationships and when you have built those networks of people that are working for you in the market, they can bring you awesome opportunities like this one. This one was an off-market purchase. So it never even hit the market when we purchased it. It was listed at, or we purchased it as $470 with a down payment of $241. Our loan product is very, very similar, actually lower interest rates, which is interesting. And we did a 10-year interest only with 30-year amortization, which we can talk a little bit more about that. A lot of folks are not, they're afraid of interest only loans because of the fact that you're only paying for the interest and not really touching the principal for the first 10 years, or sometimes it's 15 and sometimes it's 7. However, for investments, if you know that you're going to be making more money and building more wealth over the next 10 years, this is actually a great product because your monthly payment will be lower and your property will be appreciating at a faster rate. So therefore you're building higher equity than what you were paying on a monthly basis. So make sure that you know what you're going to be doing with the cash that you're saving on the monthly payments. Otherwise, it doesn't make sense to do interest only. For us, we do know that the more we can save on monthly payments, the more we can invest and do more deals. So it makes sense for us. So the expected appreciation is about 27% for this particular neighborhood. So in the next year or so, we're expecting to see a $600,000 growth, or not margin, but a price for this particular property, which is exciting. And the current rate is $2,500 per month. And my lesson is going to stay the same: act fast, because if we weren't ready to make an offer, this off-market opportunity would not be ours now. Now we're going to talk about 1031 exchange. So if you've ever done any research online about real estate investing, you might have come across this term 1031 exchange. So in real estate, this particular terminology is used when you are an investor, an existing real estate investor that is going to use the capital gains that you've made on the investment property and defer the capital gains taxes to the future years. So by definition, this is one way for you to not necessarily pay capital gains taxes today when you're going to sell the existing property for a like property. And the like is pretty generic and it could be misleading. It does not have to be the same kind of property, meaning that if you're selling a condo, you don't have to buy a condo, but it has to be the same amounts at a minimum for you to be able to defer the taxes. So here's an example of one deal that we did back in 2013. So we acquired this condo in 2010 for $175,000. Or sorry, 13 for $170,000. We sold it in 2017 for $380,000. And of course, there was quite a large capital gains that we had made on that particular investment. And instead of us paying the taxes on it right then and there, because we wanted to make sure that we had more money to purchase a bigger property, what we did was a 1031 exchange program, which usually involves, not usually, it always involves a third party. It's called a 1031 exchange company. It's very similar to when an escrow company gets involved in your transaction. The 1031 exchange company will be a it's going to be a party represented in the transaction. It gives you 45 days to give them a list of identified properties that you're going to potentially be pursuing. After the 45-day window is finished, you have 180 days to close at least one of those properties. It is not limited to how many you can do, but it has to be for the minimum amount of, in this case, $380,000 that we would have to invest in the next purchase. You could divide that into 4 different properties if you wanted to, or you could just put it in one property. That being said, there is a fee for a 1031 exchange company at the end of close of escrow that you have to pay. Usually it's between $600 to $1,200 depending on the size of the transaction. And they're going to be communicating with you throughout the way about what part of the process you're going through, and they're going to guide you through which stages you are in. But it's very important to have your CPA involved from the very beginning of this process, because it could get very crazy with this 1031 exchange if you don't have your CPA involved from the very beginning. So what we did is we took the $380,000, did not pay a penny of taxes. We put it into another property in San Francisco for $625,000. So we actually got loans, put the $380,000 into the next property, and then now increase our portfolio to $625,000. So if you take a look from 2013, when we had $175 all the way to 2018, we grew it to $625,000. And even still, we have not paid the capital gains taxes on it. It's deferred for the future. Whenever we're ready to actually pull the money out of real estate and want to use it for any other purposes, that's when you're going to pay the taxes. And usually people never do that because it just goes on and on to the next project and the next project. And that's how it works with 1031 exchange.
Yeah, Panise, before we move on to the syndication process, can you share with us, I know you had stats on Austin year over year, that zip code that was on top, the appreciation. What was that?
The 27%?
Yeah.
Yeah.
So what I was referring to, guys, is Panise, as she invests in Austin, there's certain zip codes that are appreciating year over year over 20%. That's how hot the Austin market is. And that's why when she says act fast, if you know that the market's moving fast, even within a couple months, you miss an opportunity. I think that first one that you had shared, that one even was, 15 divided by what, 500 or 490, which was an investment, which is a huge percentage over 2 months.
And another thing I would say to that, Wilson, is that the 1% rule in the rental is a great rule to keep in mind when you're making the investment. For us, that is not really top of mind because we're really focusing on the gains and the equity builds and the appreciation. So when you look at a market like even the Bay Area, it's very difficult to get the 1% rule on the rental or the price that you purchase a property and get 1% back. However, the way that you can recover from that is if you go into an appreciating market like Austin or the Bay Area, you could recover that with appreciation and the gains that you're going to have year over year.
Right. And going back to the chart earlier too, you don't have to go back, Annie, is going from appreciation eventually to cash flow. What if you exchange it into a super cash flow heavy property after all those gains in Austin? Because Austin is likely appreciating at a multiple compared to other markets. So it's good observations and different ways to invest. There's no right or wrong way. It's just people have different priorities and it's important to understand them. And then that's where you think to yourself, what's important for me when I start my investing journey. So let's talk about the syndication process. Syndications are new for me as I started investing in last year. Syndications are purely passive. I don't have to do anything. I don't have to source any of the four vendors, the real estate agent, the lender, the property manager, the contractor. Of course, there's going to be pros and cons to that. But for someone that, for myself, I'm running a business, that's where most of my focus is in helping clients locally, that sometimes I need to diversify my investment. So if it's purely passive, it's a benefit to me. So in some ways, it's just larger scale BRRRRs. In this case, I took this from DJE Texas, which is one of the syndicating firms that I had invested in. I'm going to give you some numbers behind it. They acquire, they reposition it by making improvements, by lowering expenses to increase the cash flow. And there's usually a period of time that they hold the investment. As they lower expenses, increase cash flow, it increases the value of the property. And when they end up selling it, it's for a multiple of the original investment. We'll move to the next slide. So in this one, they are saying that you should have a 17% annualized return, which over the 5-year hold period, you're going to get a 1.85 multiple of your money. Now, I realize nothing is guaranteed. However, most of the time, just like anything in business or in investing, find the right person to invest with, right? So it comes down to the people. For investing out of state, even if it's a single family residence, the team is what leads to success or failure. Of course, your intuition, also you deciding on which market, but sometimes it just takes one horrible tenant for it to screw up the whole or screw up the whole ownership, right? So for this one specifically, investing $100,000, you are guaranteed a cash on cash return of 7% annually. So you get distributions on a monthly basis. And then at the end of the life of the transaction, when they sell it, they're expecting an equity gain based on repositioning the property. So your total return on the lifetime of this investment, which they usually project to be 4 to 6 years, sometimes faster, sometimes slower, is you'll get $185,000 back. Now, usually, one of my mentors have shared with me, how can I look to double my money every 5, 6, 7 years? Investing in this means over a 5-year period, the multiple is 1.85. So if they held it for another year and if they could reposition it any more, let's say in a different scenario, my multiple of money would be 2 point something percent, which is over a 5-year period. I put $100,000 into this investment. 5, 6 years later, I'm basically getting $200,000 back. We know friends that have invested in many small lump sums into syndications, and that's part of their portfolio holdings, which make up a percentage of the assets that they hold. So this is just one example, and it doesn't even include the benefits that they'll pass on to you as a passive investor for a cost segregation study, which we'll talk about in a little bit. We'll go on to the next one. Here's another one. Unfortunately, they sold all the investments positions before I could make the investment within a 28-hour period. This one, if you invested 100,000, it's a slightly longer hold at 6 years. At the end of the 6 years, you would get a multiple in return of estimated 1.97. The interesting thing about both of these two guys and their companies have a track record of outperforming that and have consistently given a 2 point something multiple in that hold period for whatever property they have invested in and repositioned in the past. So this is a purely passive way for you to do it. Like I said, it doesn't include any sort of cost segregation study that they'll pass losses on to you. If you can claim yourself as a real estate professional, you could take that loss against your income and pay less taxes. So, and once again, I'm not a tax professional. We'll go on to the next slide. Now let's talk about a cost seg study. So just something that we've done is we purchased a commercial property at about 1.58 million. The property itself minus the land, the building costs was estimated to be $1,058,000. And actually with a cost seg study, I'll just read it, is an application where you can accelerate depreciation of certain parts of the property. The savings generates substantial cash flow, so you can reinvest that money because you're taking a loss against your income, which means you're paying less taxes for that year that you take and claim that loss, which means you have more cash to deploy upfront versus over the life cycle of the property, taking more of the depreciation upfront versus over the period of the years that it would depreciate. So this specific property, the building is valued at $1,058,000, and we are likely going to be claiming a loss in the first year of $218,000. So for those that have high income and you can claim yourself as a real estate professional, this is a way where it's showing you at the end of 2020, for example, there's an estimated accumulated tax savings benefit of $63,000 and some change if your tax rate federal is 37%, right? So, but we can talk a little bit more about this. Overall, that's one thing I've learned. That's why people keep exchanging into bigger and bigger properties. They're deferring the gains on the property while they're depreciating a bigger and bigger asset and at an accelerated rate. So we'll move on. Now, this is one of the last slides we're going to talk about. This one I'll explain as best I can. Average inflation in the United States since the 1960s is 3.7%, suggesting that the cost of goods and services will also double in roughly 19 years. So in the chart, how can we hedge for inflation? And this is just something that I punched in, and there's some assumptions here, but hopefully you can understand it. Let's say I had $250,000 cash today. Years later, it sits in a bank account. Whatever the bank's giving me in an interest rate is point something percent. I don't even know. It's very low. Let's assume when after 19 years, I keep that cash, it's likely still going to be worth about $250,000 in the same account. Now, in the column that says buy products and services, if I spend that money, I'm going to have no value. Let's say I buy a Lamborghini for $250,000. Over 19 years, it's probably not going to be worth nothing, but it's going to be depreciating, right? There's no tax incentives on that. It's not generating me income. You know, maybe it makes me feel good, but it's not an asset that appreciates. Cars typically depreciate. I know there's some cars out there that appreciate over time, but in terms of, let's say, whatever I buy for $250, it's a service and good. That means I'm not going to have money 19 years later in my bank account. Now, let's assume over that same 19-year period, because of inflation, the same car in 19 years is going to cost me $500,000 to purchase. So how do we hedge for that? How do we make sure that, yes, we can continue working and making income, but if income is in some ways might not grow in relativity to the inflation, how do we hedge for that? So let's say I buy an asset for cash. I spend $250,000. I buy an asset that over 19 years is going to appreciate relative to inflation. So it's worth $500,000 at the end of 19 years. That's a win, right? It's better than having $250,000 in cash. However, if I had to liquidate it because I need the cash to spend on a goods and services because I have to live, I have to pay taxes, capital gains taxes. In this situation, I'm assuming it's a 30% tax rate, which means at the end, I have $425,000 to spend. But if the goods and services is costing $500,000, that's not a win. I can't even buy what I wanted to buy, right? So now this is the power of leverage. Let's assume I use that same. So now we're at the section where it's buy an asset with cash plus loan. Let's assume I have the same $250,000 and I buy a piece of real estate. The bank allows me to fund 75% loan to value. So I can buy an asset that's $1 million. With the $1 million asset, assuming it's appreciating alongside of inflation, after 19 years, it's going to be worth $2 million. After taxes at 30%, it's going to be $1.7 million. Of course, if I sell it, I have to pay off the loan as well, right? So my total value at the end of that, the only thing that's missing in that equation is the interest that you'll pay over the 19 years. But also, what's missing from that equation, if it's an asset and cash flow positive, what about the income I'm getting for it during those 19 years as well? So how do you hedge against inflation? It's not keeping cash. It's not spending money on services or goods. Of course, we need to. It's not just buying an asset with cash and not having a loan, because I know a lot of people do have that perspective as well. They don't want to have any debts. It's actually, how can they leverage the bank's money? Because interest is so low that if I buy an asset today, 19 years later, even if costs of goods and services duplicates, my asset duplicates at the same rate, but because of leverage, I was able to buy something much bigger. So if I decided to sell it, obviously there's going to be a bigger gain at the end of those 19 years. This is an example. I provided this as well that we're going to give you so you can crunch your own numbers. But hopefully this gives you perspective. You know, working a job gets us started to have the money to invest. However, it's going to be important that we invest in assets that's going to get us a return, give us tax write-offs and benefits, maybe some cash flow as well. But the most important thing is you're building wealth. The asset is going to appreciate, hopefully, faster than the inflation that we're seeing, which average is 3.7. Currently, the government's reporting 2.0, but is it truly 2.0? I can't say for certain. So, and this is how we can help. We can help you purchase locally if you're looking for a primary residence. If you're looking out of state for an investment property, depending if it's Indiana, if it's Texas, Austin, or if it's a different area, we have partners out there that we can start a conversation for you. Of course, we're going to continue hosting webinars and having conversations. We're always open to help. And also soon enough, hopefully, fingers crossed, we can get together physically, outdoors possibly, and just be able to see each other. And for all of us, we're here to help you be accountable and support you in your goals. So part of the sheet that you're going to see later as well is there's a net worth tracker, there's an expense tracker, and hopefully all of those tools will also help you. So if you're on this call, if you've registered, we're going to send you an email with the link. You can make a copy. And our mission is to help families build wealth through real estate. Our team's here to help you. Just really thankful for all the support that we've gotten through the years. We've helped over 490 families through the years, and we're still in the process of doing and helping more people. So now maybe we can jump to the sheet so people know what we're going to be sharing with them. And if you do have any questions, feel free to type it in chat, or any observations. If you learn anything, would love to hear one takeaway that you guys have. So really appreciate your time. We've been here for about a little over an hour. Annie, if you can zoom into it. Or open the max size. That's fine. So what you'll see on the bottom is the tabs. So there's leverage calculators as well, if you can go to, the first one. So one thing we didn't talk about is something called the loan constant and how to calculate it. There's a rule of thumb when you invest in real estate, you want your loan constant to be less than the cap rate. The cap rate is calculated before you pay your mortgage. So it's the income that it brings in minus the expenses to operate it, your NOI. If your NOI/your cap rate is greater than your loan constant, that is beautiful. And also the second calculation you want is the appreciation in the market you're purchasing is greater than the interest that you're paying. That is also a second key thing that you want to look for. So when Panise was talking about a interest-only loan, typically interest-only loans have a much lower loan constant percentage than a typical loan, like including principal. So that's one thing you can look for. You're going to use this calculator so you can calculate it for yourself. Let's go to 2 over, the appreciation calculator for owner occupied. Now, the numbers that you see in the yellow are what I punched in the example earlier. And if Annie, you scroll down, you'll be able to see, of course, over the 30-year period, the cumulative interest versus the appreciation. We will share this with you so you can crunch your own numbers. You can plug in your own primary residence. One of the best investments you could make is obviously a primary residence investment and purchase, because interest is as low as it could be and you can leverage as much as the bank's money as you can. The loan to value is typically higher than an investment property. Let's go to the inflation tab. So here's a calculator that I was able to find, which you can plug in play based on average inflation, or you can change the inflation number and what the present value of money is based on inflation, and years later, what that would be worth. So, and then as you scroll down, you'll see the average inflation rate based on the historic tracking ever since, I think it said 1970s or 60s. So. Next, we'll go to Networth Tracker. Okay, so the Networth Tracker is a tool that you'll want to make a copy of, and you want to talk with your family, your spouse, whoever, obviously, that this is important to have a conversation with to help keep you accountable. It's going to track all the assets you have, and Annie, if you scroll down, it's also going to track all the liabilities you have. So anything that's a minus. The key is, just like setting a goal, until you track for the first month or for the first time, you're not really going to know how do you improve your net worth. And it's an easy calculation: increasing your asset holdings or decreasing your liabilities, the money that you owe. So this is a great tool. If you guys have any questions about how to use it and how to adjust it, feel free to ask us. We'll move on to the next tab. Here's a one sheet. I know some on the call might know what this is. The one sheet is your way of calculating horizontal plus vertical. What's your total income? What's your personal expenses minus the taxes you need to pay? And it calculates at the end how much you can invest. And once you have that number, how much are you actually investing? And also it helps you set goals on bucket list items, health measurements. And there's going to be, as we say, 8 gardens to your well-being in your life: health and nutrition, lifestyle, adventure, business, career, financial investment, spiritual contribution, personal growth and intellectual, friends, family, relationships that you have, the environment and your tribe, if there's anything that you want to prioritize. So this is another tool that you'll use. Next one. This is the personal budget expense sheet that we shared. Thanks to When May Give. Shout out to Ben Kenny for being able to provide this. This, you can plug in numbers so you know exactly how much it costs you to live on a, I believe, monthly basis. So hopefully this is helpful as well. Next one. This one is called 10 Homes in 30 Years. It shares with you, based on some major numbers that you can punch in, how much these 10 homes that you'll invest in the next 30 years would be worth if you scroll all the way down to the bottom, of course, after that period of 30 years. So pretty insane. And the next, and I think this is the last one. This is the value of optional expenses. So compound interest and compound value is key. You know, how's Warren Buffett so rich? Of course, he makes a lot of good, savvy investments, but a lot of it is because he started investing early in his life. And obviously, he says building wealth is like watching paint dry. It takes a long time. So, for example, in column 1, let's say you buy coffee on a weekly basis 5 times and it costs you $3. Monthly expense is $65. Versus if you invested that at something that gets you a 10% return over the 75 years, that's going to result in $13 million. As you can see, it really starts to kick in the later years. So that's why as you start investing in real estate now, you're going to start compounding at a earlier stage in your investing career. So, but hopefully this is helpful. You can plug and play these numbers and use these charts. This one was also from Win Make Give, which is a website that you can visit for some of these. If you need it, I can send you the link. And I think we can go back to the slides. And we just want to say thank you. Thank you all for being here. I know we have some questions, and we hope you found this presentation helpful. And if you want to have any conversation with us, we welcome it. You know, even if you're investing out of state, there is no financial benefit to us, but there is benefit in us knowing that you're investing in your future. So even if it's an intro, even if it's a question that we can answer, we're here to help you. So I think Amit had asked, do you have property management? If so, other states? We do. However, I'm not sure if we're taking on new projects right now locally. However, we can introduce you to property managers that are vouched by our partners and or ourselves if it's local. So thank you for that question. Next is question, Ashley and Panise. What % of emergency cash do you set aside for investment properties and life emergencies? How does that scale when you're acquiring more properties? Great question.
Actually, do you want to go first?
I don't believe in emergency cash. If I have to sell one of these, I'll sell it, but no, I honestly don't. We just purchased our primary residence because we were able to leverage properties out there. We just refinanced one of them to help kind of potentially put an ADU in our backyard here in the Bay Area. So I would say we don't really hold on to a lot of cash. We leverage the properties we currently have to purchase our next ones. For us, that's how we've been able to do it. And then if an opportunity came about, that's when we start thinking about either doing it. That's kind of where we're at right now, to be honest. The Westfield house, the first purchase, that's in the high twos. We're considering a 1031 exchange right now to buy more versus emergency cash. I work in real estate, so my emergency cash is essentially the cash I set aside for my tax fund. I put a little bit of my cash away every time I need to for tax purposes. So I guess if anything were to come about that we needed something right away, that's, I guess, our emergency fund at this point. And, you know, the fund that we used to keep for our fun, like our travel, we haven't been able to use that quite yet. So that's kind of hanging out right now, but hopefully that helps. I think it's more leveraging the other properties right now.
For us, it's kind of simple, actually. To your question, I think it was Jeff. So for emergency fund, we have a generic emergency fund that is 6 months worth of operations and living expenses that we save and we put aside. And that's if in a case where we're not able to work or something goes really wrong and we are completely out of money, we have about 6 months worth of reserves. For each particular property, what we do is we take a look at our operation expenses, property management fees, the taxes, if there is an HOA, and then we kind of put usually we put a 2% vacancy rate in our calculations for, let's say we're not able to find a tenant, what happens to our mortgage. So putting all of that aside, it's roughly, it's definitely less than 20% for each property that we're putting aside of the monthly operational expenses. And that does include the vacancy rates for when and if we're not able to find tenants, which actually came in very handy because our San Francisco investment, when COVID hit, we lost our tenant and it took us 4 months to find another tenant. So it came in handy to have that reserve fund for it, but it's not super big. It's just less than 20% of our operational expenses. Hopefully that was helpful.
Yeah, I'll share some thoughts on this too. One of the high net worth individuals that's a mentor of mine, he allocates 5% for high risk investments, 80% in real estate, and 15% in cash/liquid investments. Cash/liquid means if I wanted to make a decision today, I can liquidate and I have that cash ready. I think some people are holding on to a little bit more. This is all relative to net worth, by the way. 15% cash relative to the net worth, not the property value without the mortgage, but net worth. I think a lot of people are looking for different opportunities, so they might also be holding on to a little bit more. So I think also it is a risk because if you don't deploy it, I mean, we just went through 2 rounds of stimulus. So how's that going to influence inflation? Government says it's 2% right now, but is it really? I don't know. I mean, it's hard to say. I mean, if you've heard, a lot of builders are having trouble sourcing material right now because from what I know, more people see it as advantageous to get a stimulus check for income versus going back to work for minimum wage. So, there's incentives and disincentives out there. If materials for building, lumber, concrete, all this stuff, if it rises, it just means that property values will also rise too, because it's harder to build new. And we do have a housing crisis. There's a lack of available housing throughout the whole nation. I think ever since 06, 07, my good friend Daniel Del Real has recently made a video about how ever since that time, there's been a lack of new builds where there's just not enough available housing for people to live in. So, question from Larry: how do you expand your network to find more off-market properties, struggling to find any deals on MLS? Paniz, I think you found 2 in Austin recently. Tell me about it.
Well, I wouldn't call them deals because they're still pretty expensive. But it really just it comes down to your realtor. That's why it's so important to have a really good network and a good relationship with your agent. I think it really helps that we picked someone that was very local and very connected, because the way off market really works is other agents that potentially are going to have a listing, they reach out to us agents and they share that opportunity ahead of time. And if you have that type of relationship, that type of agent that has those existing relationships, then you're going to be set up for success in that sense. In our case, both off-market opportunities were presented to us by our agent, because off-market opportunities never make it to the market. So it's purely just connection based. It's purely just the office gossip that they have about a potential listing. And if you make it very clear and make it well known, and your agent knows that, your realtor knows that that's something you're interested in, then they're going to let you know when there is an opportunity. But again, in this market, I would be remiss if I don't tell you that even in off-market opportunities situation like the one we had, we were still competing with other investors. So that's something to know, that in an off-market situation, you're still going to have other folks that are getting the same off-market offer presented to them. So it really does matter that you're ready to make an offer and you're firm on it. And there are risks associated to it as well, probably more than a listing that is on the market, because the seller does not have any disclosures whatsoever. Nothing is prepared. It's just purely conversation based until they show interest, and then they get some information. But usually you go into contract without really knowing anything about the property. So it is a little bit riskier from an investment side of things, but in our case, it ended up working out because we were able to put in an option period about 6 days to get everything straight from sellers before the contract was official.
Yeah, to add to that too, it just comes down to who you know. So, in your network, or you might just be one or two calls away from finding that one person that has a lot of marketing or lead gen out there that is sourcing, whether it's apartments or commercial. So, of course, they might do a finder's fee. So, in some ways, you can consider them a wholesaler of some sort. But there's people actively looking for deals depending on the size that you're looking for. You just have to find the right person and be in relationship with them. So um Lisa asks, have any of you had problems with renters in this high unemployment market? It's scary for landlords. I definitely think there's a fair share of that. You guys have any feedback for that?
I was actually just typing my response to her privately, but now I can share it. It is, I think part of being an investor is taking that risk. The risk in our field is that tenants, and not being able to find good ones, is a risk. I did go through a very long process of, unfortunately, eviction, 8 months of not getting rent, back and forth, legal fees. So it is a lot of work, but at the end of the day, it's a lot of, again, goes back to your relationship and the contacts you have. We had no tenants in our San Francisco condo for 4 months, and we were still paying all the expenses. However, we were able to find a very qualified tenant, and part of the negotiation was that I had her sign a long-term lease with me because I knew that I wanted to keep her. So sometimes in a condition like market condition like now, you just got to get creative and you got to find a way to find the best person and be really aggressive about your approach and maybe offer some incentives. We did give 1 month of free rent, and again, like, I presented myself as the point of contact, and I was very super nice, and like I gave her, you know, a gift card for coffee, for morning coffees. And you know, you want to be like nice, and they want to like you as the landlord or the property owner if you are going to be in contact with them. So I would say it is definitely a challenge. Not in Austin, but in San Francisco, it's been a challenge for us. But at the end of the day, it worked out for us. And I think you can always, in a challenging situation, you can get creative and figure it out, but it does come with its own risks and rewards.
Any thought?
Sorry, did you say my name?
Yeah.
Okay. Sorry, my client's offer got accepted. I'm so excited. I was in tears earlier.
Congratulations.
I'm just so excited. You just have.
Are we going happy hour? Where are you at?
Oh my gosh, I'm just so happy. Anyway, I've had terrible tenants. COVID actually didn't affect my tenants, though. It was more because I didn't have property managers in place. My first one, she was a single mom. She pulled at my heartstrings, and that's when my husband had to step in and say, you're no longer allowed to be, this is a business that you're running. This isn't just like, you know, handouts, essentially, because she would just be late and then not pay. And we got to a situation where she did have to be evicted. And that's when we added in the property management team. And I would always recommend having them. They're reliable in the sense that we live in California. In Indiana, that's 3 hours ahead. And so I'm not trying to get a call, you know, at midnight or 3 a.m. or, you know, 6 a.m. either way, about something going on in Indiana. And we were actually on a cruise, and a hailstorm came in, and there was like water coming into to her home. And she was like trying to have me fix it. And I was just like, I'm done with this. And so, and then we also had squatters in Indiana. So that was another issue where it's just important to have people on the ground and changing the locks after in between each tenant. Just, you know, you just have to be mindful of those types of things as landlords and take the advice from the property managers. They're there to help. And so I think it's just going to be understanding the market that you're buying in, because yes, I think some of the next questions are about San Francisco specifically. And I think it just can be a little bit more difficult of a market to be a landlord, to be honest. We focus in Indiana, it's more landlord friendly than it is tenant friendly. We have a little more leverage when it comes to if someone's not paying their rent, being able to get them out.
Is this the portion we talk about horror stories? Because I have so many.
Yeah, I also had a tenant who told me that the house was haunted, and she sent me videos of demons attacking her children, which was honestly kind of scary. I almost felt like I had to call social services if you're sending me pictures of your children that are hurt and scraped up from the demon in the house. So anyway, hopefully that helps.
Yeah, that's
Yeah.
a pretty unique one. You haven't shared that one yet.
Yeah, no,
Mike,
honestly, she sent me videos and I'm like, what am I looking at? She thought there were demons in the video, so that was fun.
it wasn't Halloween and maybe a spouse was in a costume. Okay.
She was like, you see this orb in the photo? And I'm like, no.
She might be hallucinating. I don't know.
I think
Michael asked, how can you cash flow in San Francisco specifically without rent control? Looks like condos, but can't see how much cash flow makes sense without high down payment. 1.5 million building with a 1% rule is 15K in rent. So thoughts on that? And that's monthly too.
I mean, the Bay Area is not where you really play the 1% rule. Here, it's about the appreciation over time, where in Indiana, it's more about the longevity. Like I'm planning on holding these properties for longer, where in the Bay Area, you can leverage a little more of that appreciation. So it is hard to, you're not going to be able to use the 1% in the Bay Area. It's about focusing
more
on
like 0.1%.
No, maybe.
Yeah, on our $625,000 condo investment property in the Dock Patch, San Francisco Dock Patch, which when we purchased it, by the way, this is the difference of a year and a half. When we purchased it, this is what was happening in the Dock Patch. The new headquarters for Uber was being built. Golden State Warriors Stadium was being built out. There was discussions about Lyft and other corporate like headquarters moving to the Dock Patch. Like the Dock Patch was the hot neighborhood. And of course, COVID happened and like Uber just crashed pretty much. And nobody goes to the Golden State Warriors Stadium. So those are the things that temporarily in real estate, you might be in a situation like us right now, that the San Francisco investment is just it looks like a horrible investment, but this is why you keep it long-term, and it's an easy cash flow in San Francisco because before COVID, we would have tens of applications for that one unit in the Dock Patch. And they were all really high-paying individuals with very solid jobs and majority in the tech industry, where we felt comfortable as landlords that these people are not going to be unreliable. However, now with COVID, circumstances have changed a little bit. And of course, a lot of investors in San Francisco have been impacted by it if you're in the condo world. But I believe that it's going to come back. And as Ashley said, San Francisco or even Austin is not the market that you're going to follow the 1% rule. It's the appreciation game that you're going for.
And then Michael had another question. We're not CPAs or lawyers, but from our experience buying out of state, how do taxes work, assuming you're a California resident? What entities have you used?
I actually just spoke to my CPA today about this. So it actually does not at all make a difference. So we formed an LLC in Texas, and the LLC has nothing to do with taxes. It's just liability, purely liability protection. And the good thing is that at least in the state of Texas, we don't have to pay extra to the state of Texas. It's really just on the federal level and the California income level that we're paying. So it doesn't make a difference. In fact, my property taxes in Texas are much higher than in California. But what you can do is, if you have multiple properties, then you can use the deduction game to also deduct from your income, realized income here in California as well. So you don't have to do a foreign entity necessarily. The LLC will do its job for the protection, and the rest of it is just regular income that you would do anywhere else. If you're a resident of California, you pay the 13% and then the federal on top of it, which there's really no way to get around it based on my understanding.
I'll share mine. I have 2 LLCs, one for if we do flips, so passive income, and one for our buy and holds. So we use those appropriately. They are done through NCH. If there's any fortune builders in the crowd, I don't know if there are, but that's what we got started on 6 years ago. We joined fortune builders. You hear the commercials, Dan Merrill, flip this house. That's how we got started in investing. And so we actually use them still for our tax purposes for our investments. And so it's based out of Nevada, and Nevada is most commonly used for these types of businesses because of the, I guess, like, just the leverage and the tax purposes and things like that. So maybe look into companies such as that.
Good stuff. And that's all the questions. Well, thank you for your time, everyone. I know we went 6 minutes over. Hopefully this was helpful and gave you some insights, sparked some curiosity. We'll send out the spreadsheets. And also, if you want a copy of the presentation, more than happy to send a copy of that too. And once again, just thank you and much gratitude. Hope you and your family are all safe and well. Hopefully we can see each other soon in person. Hopefully all of us will be able to be eligible for the vaccine soon as well. So thank you, everybody.